Welcome to Transfer Pricing Solutions, Tariffs and Transfer Pricing, Safeguarding Multinational Enterprises' Supply Chains, or as I like to say, make transfer pricing great again through the use of these tariffs, given we're all going to be impacted by these as well. So let me just introduce myself for those that haven't met me before. So my name's Shannon Smith, founding director of Transfer Pricing Solutions. We started Transfer Pricing Solutions in Australia back in now 18 years ago, and we've expanded through to Singapore and Malaysia. I also teach transfer pricing at Melbourne University, the master's subject there at Melbourne University, and prior to that, prior to starting up Transfer Pricing Solutions, also worked at the Big Four for many years. I've had many government advisory roles over the years, on the Board of Tax Advisory Panel. Currently, I'm on the ATO stewardship. My role there is to tell the ATO what they're doing well and what they're not doing that well. So that's been fun and games, as you can imagine, for the last year or so. I'd like to introduce Adriana Calderon. For those, there's probably quite a few people on the call who have met Adriana before. Adriana's been with actually Transfer Pricing Solutions since a very long time, since a few years after we founded, and then helped me co-found Transfer Pricing Solutions Singapore and also Malaysia, and is based in our Singapore office. Adriana also has extensive experience in transfer pricing and also teaching. And you'll see that actually Adriana is teaching many of the webinars or face-to-face transfer pricing presentations throughout Singapore and Malaysia as well. And is an associate lecturer at the Singapore Institute of Technology as well. And then we have HC. HC has been with Transfer Pricing Solutions now over 7 years. I know that because I have to accrue long service leave now. Based out of the Australian office, but he has the great job of being able to, he helped us co-found our Transfer Pricing Solutions Malaysia, which gives him the tax deductible trip back to Malaysia on quite a frequent time. So we have that definite benefit on that side, but and HC is also a director in our Malaysian practice as well. HC is also a frequent speaker on transfer pricing webinars, seminars, and workshops as well. So in today's agenda, we're going to make transfer pricing great again. We're going to talk about the tariff effects on supply chains. We want to touch on the customs valuations and the transfer pricing alignment, and then talk about the adjustment mechanics and tools, and we're going to give some time for a Q&A. So to get us started on making transfer pricing great again, now you will know those that obviously on the tariff side is come about from our friend Trump in the US. Let's start talking about why the tariffs matter in the Asia Pacific region.
Yes, so I think it's good to understand. Thank you, Shannon, for that introduction. So I think it does matter in the Asia-Pacific region because of the rising of global, obviously, tariff volatility that can play a role in the TP and also tax from a strategic point of view. So obviously, APAC firms face increased profit erosion if you don't have a proper arm's length calibration or recalibration. And I think obviously one that is very important to keep in mind is the fact that the trades, if one looks at the trades percentage in the Asia Pacific to the US, is quite significant. So there is a need for some cross-border coordination in all the Asia Pac region to either, I guess the question in mind is there a way to go around the tariffs? And I hope that after this webinar, we can at least share some light on this point. Or is there a way that our region can survive as well? And how significant is for our region the tariffs imposed by the US? So with that in mind, maybe it will be good to understand what's the interaction and what's the impact in detail. And maybe Honchon, you are able to work with us on sharing some light so people can understand the detailed concept as to why tariffs impact TP.
Thanks, Adriana. I think, yeah, always good to look at theoretically, looking at what are tariffs, what's the impact between tariffs and TP. Now, I think we have heard quite a lot of tariffs nowadays, right? Tariffs was the buzzword earlier of the year. Fun fact, apparently, what are tariffs? Was actually one of the most searched question on Google. I think a lot of people wanted to know what tariffs are. I think a lot of in layman's people actually do not know what tariffs are in general until Trump came in with, oh, I'm gonna impose X amount of percentage of tariffs, and like, oh, what's that? How does that affect us? Right. That's when globally everyone started searching for tariffs. So what exactly is a tariff, right? So basically a tariff is a tax imposed by one country on the goods purchased or imported from another country, right? Simple as that. So when you import from another country, you have this tariffs imposed. Now, when you look at it this way, the main objectives of tariffs is more or less to restrict imports by increasing the import pricing and then make it less attractive to the domestic customers, right? So when you import, the price increase, and when consumers look at the price, they would seek alternatives. Well, little did they know that even with tariffs imposed, it may still be attractive to import rather than actually sourced domestically for certain products, especially in the US. Hence, at the end of the day, when you look at tariffs, I would look at it as a disruptor to the country, whereby at the end of the day, the overall costs of a product at the end of the day will be borne by the consumer, right? For the particular entity, for particular country that will impose that tariffs, right? So that's where we look at tariffs. Now, when we look at tariffs, the next thing we need to look at is what are the rates that are being imposed? What's the impact that as of current or as of yesterday's rates, what are the rates that are being imposed for the APAC region? Now, if you look at this table, as of now, okay, Laos, Myanmar will be 40%. India was 25%, and due to political reasons, I think India was purchasing Russian oil that US wanted to impose an additional 25%, right? Making it 50%, the highest of all. That will be 27th of August. Well, we all know that things will happen in respect to these tariffs. I think it's very volatile at the moment. It changes every time. So for China, it's 30%, used to be 125%. But for now, it's 30%. As of today, they have again extended the pause the tariff increase for another 90 days with China. And then Brunei is 25%. And if you look at the APAC regions that we normally have manufacturers in place, like Vietnam, Bangladesh, Taiwan, Cambodia, Indonesia, Malaysia, Philippines, Thailand, these two regions, these two will be around at 20 to 19%. And then the rest, Japan, New Zealand, South of Korea, Australia, and Singapore will be 10%. So if you look at it this way, a flat 10% would actually be quite detrimental. We look at how tariffs will be impacting the transfer pricing. Next slide, we'll be looking at, well, I guess when we learn about tariffs, basically customs will come in place. Gone are the days where we treat transfer pricing and customs rules differently, though they have different rules. But we really need to look at to understand the interdependency between customs and transfer pricing, as well as the differences between custom duties, tariffs, and transfer pricing, how intricate they are, what kind of relationship they have in terms of valuing your products. So when we look at customs, we'll be going through, the broad three criteria: valuation, origin, and classification. The most importantly, obviously, we'll be looking at valuation. Now, for customs, when we look at valuation, there are actually different methods, different customs methods that we use to value. In general, the custom valuation uses similar TP methods as the transfer pricing, but there are certain major differences in place. Now, interestingly, often the customs will rely on transfer pricing documentations to ascertain the transaction value. So it's really important to prepare the transfer pricing documentation properly so that you are able then to prove your transaction value equates to the arm's length pricing that is to be applied. Now, once the transaction value has been ascertained, the tariff is then calculated according to the transaction value. And the tariffs here, there are fixed tariff and we call it ad valorem tariff. So ad valorem tariff is more in Latin words, according to value. So what US has applied is more the ad valorem because of the percentage wise. So the higher the value, the higher the tariff, right? So that's very important because it goes in line with your valuation. And also to point out that during the valuation, depending on the condition of sale, the royalty or license fee may be embedded into the price, right? So that depends on the condition of sale. Once you've looked at the methods, the valuation methods, the tariff will be based on the duties and the tariffs will be based on the origin and the classification. The origin of the goods merely implies where the goods comes from, right? There are specific rules in place to ensure that, looking at the origin of the value of the goods, and then which will determine the prevailing rate that should be applied. Same goes with classification, but classification is based on the type, the product type that you're actually importing. So there are specific rules in place to determine actual rate to apply, based on the origin of goods and the classification. Once both are determined, the final duty and tariff will then be imposed on top of the transaction value. All right. So next thing is to look at, what's the differences between when transfer pricing comes in. So when we look at transfer pricing means, we are dealing with your control transaction with your related parties. So in general, import value will be based on the custom value if it's third party, and if it's related party, right, it will need to first comply the custom value. On top of that, they will need to then look at your transfer pricing documentation to make sure that it also is aligned with your arm's length value, right? So we have to make sure, again, to emphasize that, to make sure that you have the TP documentation in place, the analysis in place to ascertain the arm's length value of your product. Now, to put things into perspective, when you have tariffs that disrupts your overall supply chain, we look at tariffs, the transaction value will equals your arm's length value. So when tariffs comes in, it will inflate your overall price, your transfer price. So when your overall transfer price is inflated, it will disrupt your transfer pricing policy, wherein when you have a higher duty, then you increase your overall expenses, overall cost of goods sold. And when cost of goods sold has increased, then obviously your profitability will decrease, which means that if, for example, you have a 6% net margin for your distributor, a normal flat 10% will wipe out your overall 6% net margin, which means you actually incur losses, right? So this are the impact that will be imposed to the group. So which means that when tariffs comes in place, there are certain measures that we need to take into account to make sure that we look at how best to then realign our transfer pricing policy to make sure that it aligns with the overall arm's length principle, which we will discuss in the later slide.
Yeah, Honchan. So I guess the question in mind is, what is a tariff? Is it a cost? Is it a tax? Is it a way to make America great again? Is it a unicorn? So hopefully in the case study, we are able to share some light of what is it, because at the end of the day, it's funny for those of you who, I don't know how many of you follow the videos that were released after the tariff. And one of the things that I was quite amazed was the amount of US based people who believed that actually the tariffs were going to be paid by China. And I was quite shocked because it's like, okay, is it really an export tax, or are we really talking about something else? And that's where this case study is useful, because first of all, we need to understand that the most transfer pricing come into place when we have cross-border trades, right? So goods moving from one country to another between related parties. Obviously, we're talking about physical goods in the old-fashioned way of doing business. Now, this is interesting because the tariffs doesn't encompass the new way of doing business, which is, for example, downloading services, buying apps, gaming. But anyway, that's one thing. So as Honchuan mentioned, as we know them, I believe, and maybe you guys can disagree with me at the end and challenge me on this, that is basically a tax imposed when goods cross the border. And basically what they try to do is to make it for the local importer more expensive, and basically try to incentivize the domestic consumption. Now, the problem is that with such a globalized economy that we have, it is a measure that is, I mean, I don't want to enter into political debates, but it can be questionable because the question is, can I just put a tariff to improve manufacturing and production in the US as quickly as I need, when we all know, whoever has been working in TP or in supply chain, Shannon, you work in supply chain for many years, moving a manufacturing plan or a production plan takes at a minimum 5 years, correct, Shannon? Or what was your experience?
Yeah, definitely 5 to 10 years. I mean, it's a big undertaking to move it. It's not something that someone's going to do lightly. So even the US, with a goal of trying to bring more manufacturing back to the US, that's going to be more than 5 years. So trying to put some tariffs in place to incentivize the local production, yes, it's a tax, but then part of me thinks it's a cost that is just going to be borne by the consumer, but we will see. So let's see if we come back to TP and understanding that is cross-border transactions. Let's see this example. So we have here the typical case of a distributor, where basically the distributor buys from a manufacturer overseas, and then tariffs are introduced. So this is the best case without tariffs, where I basically do a sale of 1,000, my purchase cost is 900, my selling and administration expenses is 40, my profit is 60, and I'm earning a 6% profit margin, which is what Honchuan mentioned. So my tariff come into place, and this is assuming the best case scenario of 10%. And then straight away, if my profit margin is 6%, by logic, if I have to pay 10% of tariffs, and let me just set up the scene a little bit in more detail here. I'm talking about a distributor located in the US with a manufacturing plant happening outside of the US, and assuming here a country where the import tariff is 10%.
So the tariff comes in, and then I have an extra cost of 10%. Then I will have a sale, if we look at the column number 3, which says with tariff, but before adjustment for TP policy, I will have a sale of 1,000 with a purchase cost of 900. Then a 10% tariff cost, 40, which will be 90. And obviously we're making the numbers very easy so people can follow this basic example. Then I will have the same selling and administration expense of 40. And then all of a sudden I have a minus 30 loss, which means a minus 3% operating loss. So as you can see, putting the commercial hat, it is a cost in the cross-border trade. And then what it comes to mind, if this is TP, is like, okay, TP one-on-one, who is responsible to pick up the cost? And because if there is a cross trade, meaning to say a manufacturer and a distributor, the question that comes to mind to TP is, which tax authority is going to be happy with the taxpayer working the cost of the 90? So 2 scenarios could happen here. Scenario number 1 is assuming that my distributor in the US, my agreement with, let's assume that this distributor in the US has an agreement with the manufacturer that this distributor is a routine or a limited risk and is not an entrepreneur. And the agreement between that distributor in the US and the manufacturer is that basically the distributor should earn a guaranteed operating profit year by year. In fact, this sounds a lot like one of the clients that we have with the manufacturing of certain consumer products in Australia, where they are the owners of the brand and the entrepreneur. And then you have the distributor, and the distributor, as per the agreement, has been set to earn, let's say, 4% operating margin. So under that scenario, clearly, scenario number 1, the distributor is going to be not impacted to some extent, because under scenario number 1, where we are assuming is that maybe the manufacturer has to sacrifice part of the margin and decrease the purchase cost over here. So we will be changing the purchase cost from 900 to 835. To achieve, I'm putting here 4.15, but let's say that it was 4% or maybe 4.15, to achieve basically the operating margin of 4% agreed in the contract. Now, if this manufacturer is, let's say, in Australia or in Japan or in China itself, then the question is the manufacturer tax authority going to be happy with a reduction of the margin? And I think that's what the company needs to start thinking about. And is the reduction of 10% feasible according to the overall margin of the group as a whole? So that's key here, because if the overall margin of this group is not more than 10%, then it's like, if I reduce, maybe I'm just gonna make a loss in the manufacturing entrepreneur forever. So that's scenario 1. Scenario 2 could be a situation where my distributor is not the limited risk. It could be the principal, or it can be full pledge. And then if you think about it, if I cannot change my purchase cost, because let's say I have to pay this price to the manufacturer, then I have no choice but to increase my sales to the consumer. Yeah. So then I have to increase my sales to the consumer 1,080 over here. my purchase price stays the same as 900. My tariff is 990. My selling and administrative expenses 40. My profit 50, and then I earn a profit margin of 4.63%. So as you can see, a scenario two, if I think about it, makes a little bit more logical sense. But I wish I could do a video to explain to everyone that says that is not going to go to the consumer, because a scenario two clearly shows that is the consumer who is going to pay for it, because I have no choice but to increase my sales price. So that's the crux of the matter here. So I guess the question is, okay, so in terms of theoretical, or not theoretical, but practical things that the company should do is, okay, I need to first understand what's the impact, because at the end of the day, yes, it's a tax, but it's really a cost. So a third party will likely to renegotiate the pricing rather than just absorbing the tariff itself. That's one option. Some companies have told us, oh, okay, how about I just calculate my operating margin, and I'm just gonna come to the example here. Okay, no problem. Tariffs, let's put tariffs as a non-operating expense, and then it doesn't impact my operating margin. So the question is that, like, I know I see Honchon is laughing here a bit. What do you think about that? Is tariff a non-operating expense?
Yeah, definitely not. It's already calculated at the top. So that's
exactly. So the possibility of excluding the cost from the profit margin is not defendable either. I don't think any tax authority will say, okay, yeah, sure, operating margin minus tariffs. Yeah, that's the new definition of operating margin. So I agree with you. I think is very much unlikely to be a possibility. So I think having to renegotiate probably the price as a third party will do, and explore whether there is going to be a cost sharing to split the cost of the tariff. And I think one key point that we don't know now, but is very similar to the situation during COVID, which is that, okay, if everyone is bearing this cost in these industries, especially those who export and import into the US, then what will the post-tariff benchmarking look like? And I think that will be critical to defend any cost sharing or absorption of the tariff costs, because one will think that if the tariffs are being applied worldwide, then if you do a benchmarking post tariffs, the general profit margins will be reduced. That's my theoretical assumption that it will happen once we start running benchmarkings for 25th and 26th. And that will be critical to defending whether it is the profit margin of a distributor in the US, whether it is a limited risk, or whether it is a full-fledged. And at the same time, manufacturers that sell their goods to the US. So I think that will be key also. And I guess another question is, and if we are thinking of sharing the cost or somehow renegotiating the cost of the tariffs, are limited risk structure still available? And my first thinking on that is that it is, but I think if you are trying to share the cost, then maybe it's not a smart way of setting up your supply chain, because when you set limited risk structures, what you're really doing is giving some routine profit to one side and then keeping the profit on the other side. So maybe if the tariffs continue to be around, maybe these limited risk structures is not the best way to share the cost. But I don't know what you guys think about this. Shannon or Hong-Chun.
Yeah, and look, I think that's going to be the challenge, looking at what are operationally, and it will change the pricing, and as such with a limited risk distributor, you know, what is this just now increasing that cost base or the pricing that you've actually had for that that particular product?
Yeah.
We've still got that distributor margin that's required to be earned as a limited risk distributor. So we've still got that margin. So where does that cost that is associated go? Ultimately, you know, we're going to make America great again, but I think the Americans are going to be paying a lot more for their product, and it will filter around the rest of the world. It's not just going to be on products going into America.
Yeah.
Yep, exactly.
You know, there will be companies will be looking at it to work out how do we nearly share that extra cost. Yeah, good segue into a case study on that one, because I think that's what we're going to see.
Yeah, so I think another scenario, which is the Asia-Pac scenario, if we see it in the country. So if we have a manufacturer, so the flip coin, right? A manufacturer that distribute to the US. And that manufacturer is a contract manufacturer that has been guaranteed a 7% markup located in Malaysia, 7% markup understood as in total cost. So the tariffs make the imported good more expensive into the US. So the questions come quite similar, but comes from Malaysia point of view. Does US bears the cost of the tariff? So in other words, Malaysia will always have to earn the 7% markup that it was agreed upon because it was a contract manufacturer. Or is it worth considering whether the contract manufacturer should, or does the contract manufacturer should earn, but then that means that my 7% becomes minus 2%. So it cannot be all. Maybe some portion of it, maybe 7 to 5, assuming that my benchmarking can support that.
Yeah.
Or do I really consider a change of contract manufacturer to full-fledged to share the cost associated with tariffs? So that's the crux. Whatever decision any company makes, you have to make sure that you are in line with the costume valuation, which Hong-Chun explained earlier, that is separate rules, and the TP rules that basically support the price from both, from costume and from TP. And if you're going to do, obviously, any changes in the supply chain, then that you are fully documented and audit ready, because we know that, for example, in Malaysia, which is this example, changing a contract manufacturer earning guarantee 7% to maybe different type of manufacturer and reducing the margin is very likely to be a red light for the IRB. And then that's why you have to be basically fully ready to defend the position that you decided to take. Just a few comments to keep in mind. I think we have to keep in mind that from adjustment point of view, it's important to have some thinking about how to hypothesize the adjustments that you may have to do to factor in the tariffs proactively, to make sure that you can plan accordingly, because if you are heavily impacted, you may have to do an adjustment somewhere in your cross trade. And then you have to make sure that whatever is the change that you're going to do, you have some flexibility in your contracts, and then amend those contracts to factor this extraordinary cost of the tariffs. From a regulatory and compliance point of view, we have to take into consideration what we discussed earlier, which is that any cross-border transaction will have to comply with the arm's length principle in the import country and the export country. So if the trade, some of the examples that we have is Malaysia, US, Australia, US, Singapore, US, then you have to make sure that there is a specific compliance on the TP rules associated in both countries. And on the tariff and valuation side for costing purposes, it will be mainly US because you are importing in the US. And then be ready to have the documentation to support your costing valuation and your TP valuation. Again, to be able to defend it in both countries, because that will be critical to having less headaches in this whole changing environment. And I guess a last point is to just, from a tax and finance point of view, have a proper price modeling first to understand what to put in place from your documentation to support the evaluation, your amendments to the contracts, and from an operational point of view, what invoices changes you have to make, and to comply with the importation in the US for costing purposes. So that's pretty much on the examples.
Mm.
Any other questions? Or any other comments? No?
No.
Okay, so crystal ball here. Crystal
Yeah.
ball. Is there any way, like
Reduce tariffs.
the number one question we get asked, is there a way to reduce the tariffs? Is there anything I can do to get away with it or get out of it? Or basically, do I dig a hole in the and burn my put my head in the sand? Or is there anything I can do to get rid of this issue? So I guess for those industries that are depending on US trades, I guess you have to find a way around it and plan proactively to make sure that you consider the effect. But I think a couple of things to just keep in mind. So it is good to understand that the tariff value depends on the product price and the origin. So reducing the tariff cost requires analyzing the sale value to a related party and making sure that, is because it's the valuation, the origin, and the type of product. So those three components need to be analyzed independently if there is any possibility to reduce the tariff cost. Now, there is two things that come to mind. The first one is basically if there is an IP component like trademarks can affect the product tariff value, and maybe there is an opportunity here to consider an unbundling of the intellectual property to lower the product value, but these involve the implementation of a royalty. So what does that mean? That means essentially that the IP elements like the trademark can be separated from the product, and I can potentially import the product as a white label to reduce the declared value. Now, this is a possibility and is maybe a possible solution to reduce the value, especially when you are doing branded products. Now, one thing that one needs to keep in mind is that the payment of royalties for trademark, and like anything in tax, you do one thing and then you don't know what the effect is in the other side. So you can do it, but you have to bear in mind that royalties payments are subject to withholding tax. So yes, you might save in the tariff and you might save in the costume, but you may still have to pay some tax or withholding tax on the royalty payment. So that's why you really need to assess the pros and cons of unbundling the intellectual property to lower tariffs versus just not doing it at all, considering that you still have to pay withholding tax on royalty payments. So that's basically a possibility, but it needs to be assessed from a pros and cons and or cost saving perspective. Another question that we get asked a lot is like, oh, what about just rerouting? And this one is one that is asked a lot in Singapore, because it's like, oh, I just reroute everything to Singapore and it's done. And then that's where we kind of have to take it with as a solution that is theoretical, but it needs to be implemented properly, because the country of origin is what impacts the tariff rate. So rerouting is possible, but you need to look into the detail, the US rules of origin, because the product needs to meet the origin criteria after rerouting, because the goal is to benefit from the lower tariff without violating the regulation. Because if you do not meet the rerouting, the country of origin rules, then the rerouting is actually not very useful. So it is possible, just double check and triple check that the country of origin rules are met within the rerouting solution. So some of them that I have heard recently, I think it was in Malaysia, or even in Latin America as well, the rerouting possibility, but you have to do some level of assembly and customization to the products in the country that you're rerouting to. And then you can do the changing of the country of origin. But that's where Singapore, the hubs like Singapore, Hong Kong, become a little bit more difficult on rerouting, because as far as I understand, you need to fulfill completely the some level of modification, and there is certain percentage of modification that you have to ensure that happens for that country of origin to be moved to the new country that you are rerouting in. So transfer pricing and advanced pricing agreements.
Advanced pricing agreements.
Anything we can do?
Yeah, I think we have a lot of queries in relation to advanced pricing agreements. So I mean, advanced pricing agreements can be an avenue. So let's look at what advanced pricing agreement is. So basically, it's more or less an arrangement with tax authorities, either unilateral or bilateral. Unilateral meaning the local government versus bilateral, two governments, to come into arrangement of your transfer pricing and to agree upon and set the price between two countries if it's bilateral. Now, first, the concern will be, let's look at the existing ones. So existing advanced pricing agreements, there will be a concern whereby you have already set a price. You have a price in place. There's a agreed upon between governments, right? And when tariffs comes in, it disrupts the pricing, which make it no longer reflects the economic reality, right? Because the price has changed. So there will be an avenue with tariffs in place, with all these developments. It's actually recommended to actually considering renegotiating the APAs with the respective jurisdictions, and to make sure that it has in place any effect from tariff payments, especially the ad valorem tariffs. So as for new APAs, it can be an avenue to come up with conditions where we have tariff payments in place, additional conditions. It's very similar to COVID, but not. So COVID have the same issues where APA will be disrupted, then you have to renegotiate. Similar principle applies where we have tariffs impact. You should renegotiate, or you should come up with a new APA to tackle any tariffs impact to your control transaction. So the objective is to make sure that you're compliant. So you don't think too much about your transfer pricing anymore, while optimizing your cost efficiency between two jurisdictions. So it's not as good as reducing a tariff per se. It's just more so having certainty in your transfer pricing arrangement, whereby you wouldn't face additional queries or scrutiny by the tax authorities when questioned.
Yeah, and I guess for those who have their APA in place, right? would the tariffs make them breach their critical assumptions? And I guess the answer is yeah, you could potentially, under the tariff scenario, go and renegotiate your APA, because there is something called in APAs critical assumptions, and sometimes that critical assumption can be also associated with economic environment not changing, and then something like COVID or something like tariff can be potentially, if you can demonstrate to a tax authority that your current APA breaches the critical assumption because of the tariffs, then that could be a reason for trying to renegotiate any APAs in place as well.
So what are some of the practical takeaways that you can take away from today? I guess what are going to be some of the company's reactions? And as Adriana mentioned before, you know, it's really about getting that crystal ball out. We all are getting ready to do something, but we're not quite sure because Trump still hasn't finished with his decision making on how he's going to make America great again. That keeps changing. So what are companies' reactions to this? They're going to either exit the market. So business operations with impacted markets are just going to exit that market. There's going to be probably a bit of a wait and see. You know, policies in the short term are volatile. We've seen that with the markets, just with the share market and what's happening there. But longer term interests and trends are going to be intact. You know, should there at least be some scenario planning around exercise of developing options? What kind of options might be available to you? And I see that with a lot of clients at the moment trying to look at what potentially might be those options available to them. But it's really going to come down to actively planning and trying to implement. So many businesses are already taking proactive steps to adjust to these tensions that are going on. And, you know, you're going to have to look at, well, what might be some of those key considerations that your business is going to have to think about and objectives? And are you in a position where you've got sufficient ability to be agile in these situations and react? I think when the tariffs were first announced, I know I had a number of clients that, you know, even on the smaller end of town that were really starting to go into the US. They just even had, you know, first shipments over there and ready to go. And their whole world was about to change with some of these. Now, we've had a little bit of I guess a cooling off period where people have been able to do some planning around it. But I think it is something that we need to proactively plan and think about. What is your, you know, what's your plan A, what's your plan B, and what alternatives do you have available? Now, I think many of us sitting here in Australia, as far as consumers are concerned, are going to see some of these businesses that were selling a lot into the US, you know, Chinese manufactured products, may actually all of a sudden, I don't know about you, but I'm seeing BYD really loving us, the BYD car company. Huge love shown for Australia at this point, with tariffs in America. At that point, I've never seen them. You know, the company's so in love with the consumers here in Australia. But that doesn't help our clients and operations that, you know, maybe Australian multinationals or exporting into the US and actively you know selling into the US. So I think we've just got to be a lot more proactive in relation to, you know, into this planning as well. So some of the key points, Adriana, some of those key points that
yes,
maybe go.
So I think, yeah, I think when it comes to TP, if okay, so I guess in Asia and here in Singapore, we do see the importance of the fact that US is a big trade partner. Having said that, I guess, and I guess Singapore being Singapore is always trying to be, and it's good, trying to make sure that they don't depend only on one partner. So I think some customers or some companies they might have the option to say, okay, that market is not significant, so maybe I just put a pin on it. But for those who the market is significant, I think they have to plan, and they have to plan from the supply chain perspective and the TP. So there is quite a bit of investments inbound and outbound in the region that basically Singapore is the platform, but then the operations tend to be sometimes in your Indonesia or your Malaysia or your Vietnam or your Thailand. So because of that, there will be a significant amount of cross-border trades anyway. So I think that brings us to the point that definitely we have to plan in advance to redesign how the cross-border trades are going to look like. And then maybe if there's going to be a change of characterizations in the business model, reassess whether there is going to be some changes in the functional and risk allocation. So what we were talking about earlier, changing from limited risk to maybe full-fledged. I think the second one, very important, is refresh of benchmarking and market analysis. I think next year for us and the following year is going to be very heavy on benchmarkings because for those industries where tariffs have an impact, one will hope, and that's my expectation, that that will come out in the benchmarkings as well.
Yes.
Because then you will expect that the margins will go down. Redefine or refine the intercompany pricing methodologies if there is a need to change from cost plus type of arrangements to something else. And update if there is a change in the supply chain and in the transaction, then obviously update the intercompany agreement and the supporting documentation, and make sure that is not only in paper, that is obviously changed operationally wise inside of the organization, and that the implementation is also done correctly, because you don't want to have a situation where you say, okay, we changed from limited risk to full-fledged, and then operationally there is no change, the agreement doesn't change, and the report in TP keeps saying the same. So I think that will be a key aspect. I think it's good to understand that the tariffs will have some impact on TP, supply chain, and tax. So don't assume that your pre-tariff pricing model still works post-tariff, because it might not. Understand the financial impact and revisit your structure and update your documentation, and always consider whether there are ways to reduce tariff exposure, whether to pricing strategies, restructuring, or rethinking where and how you source from. So I think with that, maybe we can open to some questions.
Now, Adriana, we have someone who's got a question. If you go back to your first case study, the question is, how often do US companies adopt scenario 1 versus scenario 2? Let's go back to that first case study. And then we can do the whole presentation again.
Okay, so a scenario 1 could be a situation where I think the prerequisite or the assumption in a scenario 1 is that US is not the entrepreneur. So I was talking about, there is 2 or 3 cases, Shannon, you might remember this because this is like 13 years ago. One was one was a beauty product company where the principal was in Australia. And back then it was a centralized model. They own the brand, they own everything. And then US was just a distributor and sales channel, and then eventually a retail channel. So scenario 1, to answer the question, is common when the US is not the entrepreneur. You give a guaranteed routine profit, but US is not the HQ, is not the brain that started the idea of the business. I think there is another example, which was, I'm trying to remember, a product that was created first in India, and then they pass it through Singapore, and then they wanted it to enter into the US. So similar situation. So scenario one, when US is not the entrepreneur. Scenario two could be when basically you set up the US maybe as with a local partner that doesn't own everything, but owns a part of the equity, but you make them responsible for the market risk fully. So in other words, you tell them, we're going to sell you this product at this price, and you guys are responsible to make the business a success in the US, and you're responsible to make profit in the US. And if you don't, at this price that we're giving you, then it's your responsibility. So that will be a scenario two, when there is less of a concept of HQ and control, and maybe more of a concept of, okay, I want to enter the US, but I cannot do it alone. Maybe I just do with someone who gets part of the equity. And then once you enter to the US, I give you this price and you are responsible to make it a success. So that could be a scenario two, when there is full bearing of market risk. So it's not like one scenario is most likely to happen than the other. Is that for one to happen, there needs to be an entrepreneur outside of the US. Whereas in a scenario two, maybe there is not an entrepreneur crystal clear, and then that's why I agree that the US distributor bears some of the market, or fully the market risk, and to make it a success in the US.
Yeah, I think that's what Trump is going after for the scenario one, right? Where his mind is thinking that will happen. Scenario one will happen because it will affect the country of origin, and it will still benefit US. But my take would be that, again, transfer pricing is more in line with your market conditions. We still look at market industries, market conditions, increase of prices. If you look at the huge, I think I saw a video in US, one of the larger, I think Walmart or something. They have increased their price because normally they have a tag, they have a tag that says 19.95, and then they actually have a higher price on top. So they take out all the existing tags and then increase the consumer price from there. So yeah, that's my take.
Yeah, it will be interesting. They will proceed with trying to make America great, but I hope they don't destroy the whole economy as they do it. Now, today's recording will also be added to our YouTube channel. The YouTube channel is definitely better than Netflix on a Friday evening. So do like and subscribe to our YouTube channel, and that will keep you up to date with everything that's going on in the transfer pricing world and making transfer pricing great again.
I have a Betty question for the two of you. I have a quick Betty question for the two. So to the original question, what is a tariff? A tax, a cost, a unicorn, a way to tax China only?
It's a disruptor.
All of the above.
A way to destroy global trade. Maybe also.
It's taking a step back.
I think definitely a cost that needs to be planned for.
Yes.
Properly from TP, tax, and generally finance point of view when your trades are significant. Hopefully it doesn't destroy global trade, I guess.
Yeah.
That's why it doesn't continue for too long.
Yes. Yeah. And hopefully the impact of it goes through to our financial numbers when we do our benchmarking as soon as possible, because that's going to be important when we're doing our benchmarking. But thanks very much, everyone, for joining us. Now, if you do have any other further questions, feel free to reach out. Obviously, we're in Australia, Singapore, and Malaysia, but we can help you throughout the globe. So feel free to reach out. Thanks very much for joining us, and we will all catch up with you and keep making transfer pricing great. Thank you.
Thanks, Jenna. Thanks, Adriana. Thanks.
Bye.
Bye.